Hello and welcome to revision tips for SIPS Level 6 Professional Diploma in Procurement and Supply. This is Module 5, Strategic Programme Leadership, and it's Learning Outcome 2, which is to understand programme leadership approaches. So strategic programme leadership is a broad and varied discipline. It involves a deeper understanding of project management as well as high-level approach, which ensures that projects function collectively to ensure the objectives of the programme are met. So there's a definition here that says a programme is a framework for grouping existing projects or defining new projects and for focusing all the activities required to achieve a set of major benefits. These projects are managed in a coordinated way, either to achieve a common goal or to extract benefits which would otherwise not be realised if they were managed independently. So programmes differ from projects in that they do not necessarily have a single clearly defined deliverable or a finite time horizon. So what this slide is showing you is a kind of summary of the relationship between strategic programme leadership and project management. So programme management is not simply the management of multiple projects. It's the provision of a framework in which current projects and new projects are coordinated to achieve the strategic objective of the organisation. The strategic programme leader creates added value by organising these projects in response to the changing demands of the external and internal environment and managing projects to ensure that the business as a whole benefit from the project outcomes. So you can kind of see the differences here in terms of it being a framework or a process, no fixed duration, time limited, etc., etc. Now, cost management is going to be one of the most crucial functions in programme management. Managing cash flows and inflows requires well thought through strategies, which will take into account the complexity and nature of the programme. The impact of the procurement on cost management is really, really significant. The purchases of bought-in goods and services typically account for between 50 and 80% of the programme's total cost. So, approaches to strategic cost management should reflect the crucial role of procurement in this area. So managing costs successfully depend on the nature and the understanding of the cost faced by a programme or a project. The pricing strategy negotiated with suppliers is critical to ensure costs are controlled and profits are maximised. One of the most important factors is to confirm whether contracts will be fixed or variable in terms of a pricing strategy. Obviously, the fixed pricing is a strategy where suppliers estimate their costs and their fees and use that as a basis of bidding for a contract. And there are advantages of, the fixed pricing helps you to forecast. It's quite straightforward and everything else, but it's the fact that the buyer can't really benefit from any decreases in the supplier's cost. Whereas the variable pricing, the supplier will use a strategy where, maybe it's like a price plus margin or something along those lines, but it means that if the market fluctuates, any benefit, but equally any negativeness is passed on to the buyer. So you do need to make sure you choose the right strategy. But I guess, how fixed and variable costs will help to establish this break-even point is quite interesting, really, because, variable costs will increase and decrease depending on the volume. The impact of the purchasing cost on setting profit goals and achieving profitability is made very, very clear by sort of calculating the reduction of the impact of a reduction of direct expense on the overall profitability. So you can kind of see a sort of break-even point on the right-hand side. So whatever pricing strategy you think is the most appropriate, just think about the risks involved in either of those. Now, effective control of the programme's budget is integral to the programme's success. A programme which significantly over budget is likely to have achieved a much less profitability than it was originally targeted, in which case it could end up sort of losing money. But the categories of costs associated with a programme will include direct costs, those directly associated with creating and delivering the product and the works needed. Indirect costs, those that are shared with other departments or programmes. So, for example, a bit of administration, IT, staffing that may be not directly associated with the programme. And of course, the fixed costs that remain the same and the variable costs that depend on the volume used. So variance analysis is commonly applied to variables of scope, cost and schedule. But in the area of budgetary control, spending variance is the primary measure. So for example, spending of a particular material may have gone over budget, spend either because the change of price or the change of quantities. The analysis will identify what type of variance has taken place. A variance can reveal something that's known as a favourable variance, which is an actual result that's better than the expected result, or an unfavourable result. You know, this is one where the actual result is much worse than you expected. Now, value engineering originated in America in the 1950s by General Electric. It's basically aimed at improving an organisation's profitability in the context where costs are increasing and competition is fierce. And this is achieved by making improvements intentionally using the process of value analysis, which focuses on the cost and the function of the product. So value is achieved through improving the technique and the technical excellence of a product while ensuring that from a supply perspective, the product is available where it's needed to be when it's required by the customer. So there is a sort of fundamental difference between value analysis and value engineering. I mean, analysis looks at products that are already in existence. So looking at the product life cycle on the right, it's probably where products is kind of maturity stage, whereas value engineering is done before the product is launched to the market. So just before the introductory stage of the product life cycle. But there are 6 elements of value engineering. The first being selection. You know, value engineering doesn't have to apply to everything within the supply chain. The production process, materials, procedures and systems should come from an analysis of which areas of procurement and supply will produce the greatest result with the least effort and minimal risk. The second is is information. The strategic leader will need to collect facts which are important to the subject that's being selected. And that's essential to the success of value engineering. And the time should be set aside to collect information on things like cost, specs, and requirements. The third is analysis. Analysing that information takes 2 forms, cost analysis and functional analysis. The cost analysis will look at the breakdown of the constituent costs of the products, and functional analysis looks at the functions performed by the subject of the analysis. And then teamwork, utilising the skills and expertise of the entire team, which should be cross-functional. Each individual in the team will have their own perspective and ideas, but working within that team environment helps to bring ideas from different disciplines into an early stage of the design process. The 5th is procedures. You know, the procedures adopted in value engineering are designed to save time and concentrate skill and knowledge resources to be utilised in an effective manner. The 6 phases are sort of information, speculation, evaluation, investigation, implementation, and lastly, the summary. And the 6th and final one is the attitudes. This element is aimed at removing unnecessary costs resulting from negative attitudes and fear in order to release creative thinking. We're now going to look at consortium-based procurement. So a consortium is an association of individuals or organisations who pool their resources to participate in common activity to achieve a common goal. And collaborative business relationships are a key element to successful programs, regardless of the size. And by choosing a consortium, it is possible for strategic program leaders to increase the capacity of a program in order to respond to contract opportunities. And that's due to size, product or service range requirements, or the experience requirement would otherwise be outside the scope of the organisation. So how does it work? Purchasing groups source the products and services based on the needs of all of their members. And economies of scale dictate that suppliers can offer lower prices on larger orders than they could on a smaller order. So when smaller organisations combine their purchasing, they can often secure discounted rates. So achieving success through a consortium is to assess the business opportunity, select the correct entry strategy, and demonstrate that it is a business. And forms of purchasing consortium or group purchasing organisations, as they're also known, can range from informal to highly structured groups. They can also be vertical or horizontal. So a vertical group sees members of organisations from specific industries, so higher education or automotive, and horizontal groups will be members from a range of industries or sectors. Let's look at open book costing now. This requires suppliers to be open with their cost and margins in order to work with the buyers and keep the cost down. Cost transparency means that programs have access to all suppliers' charges, costs, and planned returns. The aim is not to drive down the supplier's margin. That would put them out of business. But the information should be used by both parties to identify cost savings and manage the program more efficiently. And from an incentive perspective, both sides have an opportunity to share the savings and the risks. So open book costing often takes place during supply negotiations when it can be useful to have an input from the supplier's legal, finance, and commercial departments. But the buyers need to be aware of the changes that suppliers are implementing, whether the costs are lowered to ensure that quality is not compromised or even hired for quality that might go up. So this method to work, both sides must be committed to collaboration and honesty, working together to achieve common goals. It cannot work if there is an adversarial relationship between both parties. And there are several aspects that should be checked in suppliers' cost models. Whether contingency is included, whether it includes the fixed and the variable costs, whether the labour and material costs are clear. Now, the benefits of open book costing and cost transparency is that it provides a basis for the buyer to review supplier performance. The buyer also benefits from the expertise and experience of the supplier in areas of quality control and cost efficiency. When effectively implemented, it builds understanding and trust between the two parties, and it can also lead to cost savings. It's particularly suitable for managing high-value complex projects. But the drawback and the risks of open book costing is that when it's well managed, the technique can be very resource intensive due to the regular reviews of audits. And specialist skills around finance and commercial expertise are needed to ensure that you have effective management. And if it's not managed well, it can damage relationships between buyers and suppliers. So we're now going to look at estimating budgets for projects. And the success of a programme depends on each of its constitutive projects being managed and executed well. Now, three commonly used methods for estimating costs is firstly parametric, which is an estimate generated by calculation or algorithm using actual results from past projects. And this shows also the defined parameters like the scope, duration, and complexity. Actual results of similar projects in the past and well-defined parameters give us a comparative for the data to use on similar projects in the future. That gives us a way of estimating the cost. So actual results of those projects, this is basically the cost estimates for each component of the project. The bottom-up approach shows that the projects are amalgamated to produce this overall estimate. So cost estimates from each component of the project or programme, the bottom-up estimate is regarded as producing the most accurate result, but it is the most time-consuming and the most resource-intensive. So two other methods of cost estimates include an expert judgment, a three-point assessment. It's usually something like best case cost, most likely cost, and worst case cost scenarios. Now, measuring, monitoring, control and improvement. Now, measurements and tracking of resources helps to identify and address areas where issues have arisen. Excessive costs or poor quality outcomes can have significant impacts on project and program performance and bottom line performance of an organisation. So project performance can be measured by breaking the project outcomes and activities into smaller measures, which can help the project team to organise their tasks and activities. Now, project monitoring and control systems. The monitoring is important as the plan of how it will be executed constitutes an integral part of the planning stage. And monitoring and control process will help to identify where improvements are needed to keep the project on track. And reporting is the collating and monitoring of reports from the project team to report back to management. So using a minimal deviation from the project plan, even when faced with unexpected events, the status of the project is identified, it is reported and compared against the plan. And any reasons for deviations should be investigated with the appropriate corrective measure taken. Project manager collates the information and the monitor reports from the team and will report it back to the project board. But the report will include things like the financial information, progress against the initial plan, accountability and ownership, as well as the risks and earning value analysis. This is used to monitor the progress of a project. It compares where a project should be, known as the planned value, to where it actually is, known as the earned value. This helps program managers evaluate whether the program is on track to meet its targets. So you've now looked at how projects are monitored through reporting and analysis. A well-run project will include further proactive steps to maximise the chances of keeping it on track. This often relies on the data gathered through monitoring and control procedures. So we're now going to talk about something called cybernetic control. A common approach to project is that cybernetic control. It's based on the theory of a kind of closed loop electrical engineering. So how a signal is fed to a system which contains monitoring circuits that detect any distortion. The system feeds back correction signals that remove the errors. So it's just an example on the left-hand side about how that works. You will need to think about, tolerances and exceptions, because there are going to be things that kind of fall outside the norm. And you can use a kind of traffic light method. Green work is within tolerance, amber it's within the tolerance, but is likely to depart from them if we don't take some action. And red works with exceeded tolerances. Another approach is the critical path method, which you can see on the right-hand side. This shows how exceptions to the project duration can be identified in order to keep the project or program running to schedule. So it's calculated by combining the expected duration of each activity, which needs to be completed in order to achieve the project objectives. It shows the dependencies between the activities, and it shows which activities have slack and no slack, which is an amount of time an activity or project can be delayed without delaying the overall completion. So now I'm going to look at controlling variations, claims and compensation events. We'll start with control variations. So we've looked at ways of managing unexpected changes and deviations from the project plan. And much of the response to such changes is centred around minimising them and ensuring the project proceeds with the original agreed boundaries of scope. But it is important to know that you need to predict how to respond and control a variation from the project. They're often discussed in the context of the construction industry, in which changes are standard during the project after the contract has been signed. So how do we manage variations? There are many potential effects of variations which can be minimised or avoided with careful planning and management. So you can do it either before the project begins, so avoiding disputes over variations. So you could have a variation clause which specifies the procedures for the generalisation and assessment of any variation orders. It should also include how the cost for variations will be calculated and how the risk will be shared, and specify that changes can only be incorporated into the project when a variation order has been submitted. And the project plan and brief should be clear and detailed as possible. The second way you can manage the variation is during the project, having communication between contractor and client and the project team. And that's critical to minimising any disruptive effects of a variation order. But similarly, disputes can be avoided by being honest and transparent with the client about how variations will affect the costs and the schedules. And the last way we can deal with this is through claims and compensations, particularly those pertaining to construction projects. They will include a variation clause in order to allow the client to make changes to the original scope of work. The contract should, however, also include a claims clause. And the main purpose of that is to ensure that the contractor is compensated for any clause, so from any claim and any cost incurred as a result of an unexpected event. Now, remedial action is the name commonly given to the task which corrective work that has been carried out within the project. It's a form of corrective action, but it's distinguished from those equally important tasks which prevent the problem from reoccurring. But remedial and preventative actions will often be implemented together. So the corrective action generally refers to a process in which problems are initially identified, the causes are analysed, solutions are applied, and processes are changed to prevent it from reoccurring. So an example on the screen, you've got the 8 disciplines approach, or the 8 Ds model. This problem-solving approach aims to prevent, contain, and correct problems, and it has its roots in the Ford Motor Company, but is spread to way beyond the automotive industry, and it's now really, really common in industries like healthcare, retail, finance, and the government. So it starts with kind of planning what you're going to do, create your team, define and describe the problem, then try and contain it, identify the root cause using kind of Ishikawa fishbone or the 5 whys, what your corrective action might be, implement and validate the corrective actions, take preventative measures, and congratulate your team for solving a problem. Now, whenever a party defaults on its contractual obligations, the other party is likely to suffer a loss. And losses can be significant. So clauses are included in the project against large costs. Now, limitation of liability is particularly common in construction projects. In cases of major default, the other party may suffer a direct loss or a consequential loss. Direct losses arise directly and naturally from a breach of contract, so damage to a property, whereas the consequential loss occurs indirectly from the breach of contract, so maybe the loss of profit or loss of opportunity. But generally, the most unpredictable are often more significant. And liability limitation often focuses on these types of losses. So procurement professionals need to limit the damage that are due to suppliers if their organisation defaults on its contractual obligations, protect the project from the effect of breach of contract by major suppliers, and it's in its interests of the project that recoverable losses are unlimited, and suppliers would wish to restrict those losses by excluding consequential loss. But contracts generally allow for recovery of direct costs, but include a limitation of any indirect costs. And without these warranties, the project may be considered too high a risk for suppliers to enter into. And contracts that limit the supplier's liability are often the most cost effective. Now, in cases of repudiatory breach of contract, the other party can terminate the contract and sue for damages. Damages are the measure of the loss or harm suffered by the innocent party in the event of a contractual breach. And the types of costs that could lead a party to sue for damages would include scope changes, acceleration-related costs, delay-related costs, disruption-related costs, or even termination-related costs. And it's quite typical that the injured party will claim for more than one of those categories. Now, liquidated damages, for some projects, this benefits from including in the contract a set amount for damages which would be awarded if the party breached the contract, but they're particularly common in construction contracts. So you agree to pay damages to the contractor based on the cost they would incur for completion of the project if it was delayed. This benefits the client since they do not have to prove the actual loss in the event of a delay. And contractors may also benefit because their liability is limited. But essentially, liquidated damages are pre-estimates of loss, and they're calculated by forming that genuine estimate for any cause of delay. So rent, fees, storage costs, loss of income are likely to be determined within liquidated damages. And then we have unliquidated damages, and those are at large, that is, that they're not decided in advance. And they allow a client to recover losses that would not have been predicted or calculated in advance of the breach. But the client is obliged to provide their losses and prove it, which is really complicated and will often require an expert. So it's things like loss of profits, wasted cost, loss of opportunities. As you can see, it's really complicated. And generally speaking, a judge would make a decision about what the unliquidated damage was. So we've looked at some of the ways that contracts might end early and the consequences of major breach of contractual obligations and the huge impact of contract breaches by major suppliers. Now, purchasers have a critical role to play in minimising these risks posed by these events. And the risks are managed through the duration of the project, but also the contract drafting stage. And one of the main ways to limit risk is by including well-defined and appropriate warranties and conditions. But what are they? Conditions are written into the contract as essential stipulations of the purchase. So that is, if the contract was breached, the contract will fail. So for example, it might be a condition of the purpose of that the goods function as described, or the product is delivered within a particular time. And this is known as a kind of time is of the essence clause. For this reason, when contracts are breached, the buyer can terminate the contract and seek damages, or they can continue or affirm the contract and seek damages. And then warranties are secondary, as they do not present the main purpose of the contract, or they don't represent the main purpose of the contract. So a warranty might stipulate that goods are of a particular age or condition. But if a warranty is breached, the buyer simply cannot reject the goods and terminate the contract, but they can seek damages. So there are two basic types. You've got express and implied warranties. And as the name suggests, an express warranty is a statement that's been expressly agreed when the goods are sold, but implied ones not necessarily the case. And in some cases, indemnities are attached to the warranties. They specify that the party that breached the warranty will compensate the other party for loss and damage. And they can form an important part of risk management. And purchasers should therefore consider whether they insist on the inclusion in the contract or not, identifying what, if any, benefit it could add. And then the inanimate terms is the middle point between a condition and a warranty. It's often considered to be no man's land and criticised due to the way the inanimate terms can be interpreted as either a condition or a warranty. And it depends on the circumstances to which the potential breach relates and the effect the breach has on the injured party. Specific performance. This is when an innocent party is rewarded by receiving what was initially negotiated rather than awarding damages. So the general principle of contracts is that any breach gives rise to a right to claim. However, there are occasions when an award of damages may not be sufficient remedy. Such situations typically involve rare or unique circumstances where financial compensation couldn't replicate the benefit that would have been realised had the obligation of the contract been performed. So in this situation, an order of specific performance will be given instead. You would use specific performance if adequate remedies were not available, or the contract needs to be valid and enforceable. So it must be there to satisfy the basic needs of the contract. And you have to ask yourself as well, has the innocent party performed its obligations under the contract? Because the court will consider to what extent the innocent party has performed or is willing to or able to perform their obligations. And there's a balance of interests and hardships. But the difficulty is in the enforcement. The existence of specific performance may be awarded, but will depend on how easy it is to enforce or monitor the performance of the breaching party. And the court wouldn't make an award for specific performance, which requires constant supervision to enforce, and may even suggest alternative forms of specific performance. So much of the work involved is in minimising risk associated with these large contracts. And a lot of it happens at the contract drafting stage. As well as the conditions and warranties, the contract will usually include a termination clause. All contracts will terminate either through satisfactory fulfilment, mutual agreement, or resulting from a trigger such as a breach of condition. So well-written termination clauses will clearly state possible trigger events, which will save time and money if the contract does come to an end early. So why do we include this termination clause? I think, when making a legally binding commitment to buy a supplier's product or service in a particular amount of time, it's not possible to tell what might happen during that period. So termination for cause or convenience to a contract, or termination for cause would definitely be because of a result of a major breach. But in the absence of that, then you can terminate for convenience. It's, saying changing your mind. It's a no-fault termination clause. Nobody's done anything wrong. But nonetheless, you will still have to give notice period and the amount of compensation the supplier might be entitled to for you terminating the contract early. And typically, the very least the supplier is entitled to is payment for all the work completed so far. So many termination clauses state that the supplier will also be entitled to the profits they would have incurred had the contract been completed. Whether the supplier is able to claim for these loss of profits is a matter of negotiation between the two parties. And this is all about agreeing compensation. And then in terms of limiting the impact of a supplier termination, this is one of the downsides, I suppose, of termination clauses. It can have a major impact on a project and takes time and expense from from a partnership with a major supplier. And then to lose them midway through a project can really lead to lots of delays and extra costs and a lot of associated risks. And what happens if there is no termination clause? Good question. If two parties enter into an agreement, the law requires that a reasonable notice to terminate will be given. And what is meant by reasonable will obviously vary from one case to another. From industry standard, the value and importance of the contract, how long the agreement has been in place, exceptions of both parties when the agreement was made, and any discussion or negotiation about termination, as well as the formality of the agreement. So let's look at obtaining client acceptance. As the programme starts to come to an end, it remains extremely important to maintain regular communication with the client and to continue to keep control of all the constraints. It can be the case that as a project team, the members begin looking ahead as to what's next. They lose control and lose sight and sometimes that means the project drifts. So what you can see on the screen here is the Prince2 methodology of the closing the project process, which will include these 5 processes in terms of preparing planned closure and preparing for premature closure. The handover of products, evaluating the projects, and recommending for project closure. So by ensuring that client acceptance is part of the first process, the manager can prepare for closure. In some programs, obtaining acceptance will be something that occurs at various stages. So in terms of defining acceptance, that's quite a difficult task if the requirement of the client were explicitly agreed at the initial stage. Now, once the program has attained the client acceptance of what it was created to deliver, attention must be paid to how to transfer these deliverables to the client or the end user. Even if the client is happy with what has been produced, if this transfer is not appropriately managed, the client will fail to realise the benefits of the work of the program. So what you can see here is the transfer of deliverables within the project closure. Now, all deliverables exit criteria need to be met. The transfer of deliverables to the customer and support functions. And then you have something called a PIR. This is a project initiation report that records the recommendations and lessons learned for all the future projects. Now, much of the time, the term project review and project audit refer roughly to the same thing. It's an examination of the project's performance. At the close of the project, its purpose is to gather information that can be used primarily to benefit future projects. But it focuses on specific elements like the quality assurance and the schedule. Although as part of that closure process, it's more likely to concentrate more generally on the lessons learned. So the procurement department has an important role to play in knowledge management. The audit is carried out usually, well, it can be done by an external or an internal person. What you're doing is you're comparing the project performance against the initial project plan. So you'll be looking at the original PID, the project initiation document, the business case, or the project plan. So you're looking at costs, schedules, and tolerances. This is used in the public sector and anything of kind of high financial value. It verifies that all project costs invoiced were specifically for the benefit of the project. It can be carried out by externals or internals. So externally would provide a very independent assessment, whereas internal audit will probably be done with the project manager. But auditors and external parties, if the project is large of a high value, is generally done by an external because they can generate a far more sort of unbiased view of the situation. So the Association of Project Management defines knowledge management as systematic management of information and learning. It turns personal information and experience into collective knowledge that can be widely shared throughout the organisation and profession. So, as I said earlier, procurement has an important role to play in knowledge management. Their procedural knowledge is crucial to the success of projects, and well placed in gain knowledge from their supply chains. They can facilitate and enhance the exchange of information and knowledge through the relationships with both the external and internal customers and suppliers. Assuring efficient knowledge management at the close of the project is much easier if you've been part of the project throughout its duration. So Ginger Levin recommends, for ensuring knowledge management is built into the project plan, make knowledge management a work package or a work stream, a work breakdown structure. Establish a point of contact for knowledge management in each project. This person could report to somebody's responsible for the knowledge management at program level. Then define the roles, responsibilities and accountabilities for knowledge management. This should be done using a responsibility matrix or a RACI. And then communicate the importance of knowledge management. So here are some of the knowledge management activities as part of the project closure. You do project post reviews, project post appraisals, after action review, debriefing, reuse planning, cooperative project evaluation, reflection, corporate feedback cycle, and post-installation or implementation evaluation. But as you've seen by now, the project closure phase focuses heavily on ensuring that knowledge management is a priority and that reviews and evaluators as an important method for capturing knowledge for the benefit of future projects. So the results of these reviews are only useful if they're well communicated, and there are several directions in which this communication must flow. Firstly, the review evaluations and learning must be included in the project documents, which is communicated to the project board. Secondly, the lessons learned from the project is identified through reviews and analysis, and this should be communicated to the other project managers. And thirdly, the project team and other key stakeholders will benefit from the communication of the results and the review activities, which you will look at in each turn. So, with the board, for most projects, the reviews and evaluations are submitted to the project manager to the project board. And they'll consist of executive managements as well as representatives from the users and suppliers. But the project manager, there's a difference between explicit and tacit knowledge. So it's really easy to communicate that between project teams and project boards, but ensuring that all reviews and learnings are documented and shared with the relevant stakeholders can help us, to face some of the lessons learned by project managers because they fall under the category of tacit knowledge. And then in terms of the project teams, the last one, learning can be communicated to the team who have worked really closely together. And it's ensuring that that explicit and tacit knowledge is gained through the project and it doesn't disappear from the members as they're released for new work. So the methods of communicating learning to the project team members is distribution of a project report at the end, team-wide knowledge sharing sessions, or department-specific knowledge sharing sessions. So that's the end of Learning Outcome 2. Thank you very much for watching.